Hi, everyone. Basil Chapman sitting in for the one and only Tom O'Brien. My pleasure to be. Usually I am on 11 o'clock till noon Eastern Time, Monday through Friday on market days. The Tiger Technicians Hour is the name of the program. And it's the same number, 877-927-6648. And the second part of it is that I have a service called The Opening Call. That's a daily newsletter in which I send out, for starting from, 6:30, 7 o'clock in the morning. I start sending charts out. What you do is you go to the front page of TFNN, you sign in with your password, and then you just start seeing the charts come in. Usually the chart that starts it off, in fact, I've already started it for tomorrow. I'll make the changes necessary when the Dow closes, but I've already started writing it up for tomorrow, and then I add to that, and then I add other charts. This is the daily Dow. I do a study based on the Chapman wave methodology. What is that? That is a technique that I developed over the many decades, and it's available at TFNN. It's called Introducing the Chapman Wave Methodology by Basil Chapman, chart analysis in the stock market, and it's a CD book. It gives you some exercises, gives you chapters on all the different chart formations that we're looking at. You know, to make it real simple, let me just go to number 23, slide 23 out of 76 slides. You see, you can look at a blank chart, and there's nothing there, just the bar. What I developed was a technique of just using the labeling of uppercase letters for moving up and lowercase for down, alphabet going from A to G. And looks like this. The next thing, I could have used numbers, but at the time that I was developing this, there was a person called Robert Prechter who was discussing intently throughout the different networks the Elliott wave, and I studied the Elliott wave, and I found that just in my particular way that I looked at charts, it was far too confusing. This is a very simple way of looking at the most identifiable low bar and then merely counting each successively higher peak, and each peak should have gone to at least peak D. That's the fourth highest peak, and then you could restart. You could go to 6 waves up. You can even go to 7 waves up. And in this particular chart, this is what it looks like with the letters. And this is the SOX wave from 2005, I think it is, 1999 to 2000. And then with the arrows. So we'll use that, and I'll show you some of the techniques as we move along. Let me go through the numbers, because that's the most important thing. Right now, the Dow, in my work, we went from a sell signal to a sell mode very quickly 2 weeks ago at the end of the week. And what we're looking at, we've been, in my opening call, this is very unusual for me. We've been mostly short for a couple of weeks now, and adding to positions and taking profits and getting back in. And so at this particular point, this particular candle here, look, on the way up, when you went from 16,333 on the 7th of August, look at those beautiful candles right there with the white background. In this case, I've used the white candles. On the way down, I'm using black candles. So on the upward way, the up days had lovely white candles, and they're nicely spaced, and it went very nicely to that peak D. Remember, we're supposed to go to a peak D. That's at 17,161 on the 4th of September. Pulls back on the 12th of September, goes to 16,937, and then has a sudden spiral to the upside. I call that in my CD, it's called a right arm extension. I was going to go there, but I won't take up time. A right arm extension, meaning that not both of the MACD and the stochastic, my two major indicators, would be aligning, and at some point there'd be a very quick failure, and that's exactly what happened. The stochastic went just over 80% for a day, and then plop, came down. And that was at a peak E. That's the 5th highest peak. And that's what I call Chapman wave right arm extension. And then what I expected was that we would see a series of lower lows and lower highs. On the way up, it was higher highs and higher lows. On the way down, you should see when you go from a sell signal to a sell mode. So making that a very simple testimony to this particular technique, we have gone down to the 16,674 level, had 2 days of rallying, went to 17,099. We went back into the short position after taking profits. I think it was on this bar right here, and we're back to the short side. And look, ugly candle. And we're at the low of the day at 16,781, down 210 in the Dow. Now let's just go through these things one at a time. We have, this is the market. I'm not used to this being here in the afternoon where the market is still working its magic. Just had Dave White just did program before me. Great program. Thank you, Dave. Talking about GoPro. Look at this. Using the same technique, GPRO. What did it do? It went to that requisite leg D right there today at 98.47. The 120-minute chart has gone A, B. Now, that could be a C, but in fact, what it is a continuation of that peak E, and I'm calling this, at least for now, an F/C, and I would not be surprised if tomorrow we see the first really sharp pullback, and that continues for GoPro, at least to test and break under the 79.13 low that was made recently. That's the way I'm looking at it right now, on one condition. On one condition is that tomorrow it has to take out 90 on the downside. If it doesn't do that, we could store it here a little bit longer. So if it takes out 90, everything's set in place to come down. And that's using this basic technique that I was talking about. Now, let's do something else. The S&P, SPX.X. This is the S&P 500 cash index, trading down 22 at 1942. Now, this is very interesting because, let me just double check. I don't want to speak out of turn. We went short on the 22nd via the 300% long position of the SPXS. That's the daily direction shares S&P 500 bear 3 times. So the low was 23.07. We were 50 cents off the low, which is an all-time low. And you have no idea whether or not you will make. There's no guarantee that you're going to make a D. But look at this. This is leg C. If perchance in the next 2 days or so, the SPXS goes above 26.46, that'll make leg D in the daily chart. And at that point, you're going to say, okay, now you've got to get ready for a counter trend rally. But the irony is that the weekly chart has still only got a leg A. And there's a good chance if we have turned the corner in the weekly charts, if the tide has turned from going to up to high tide, now coming down to low tide, we should make more than a leg A and a B to the upside. We should probably challenge that candle right there of 27.92 that was made the week of the 8th of August. So let's go back to the SPX, because this is what most of you would probably look at if you're looking at the different indices. Most importantly, there's a yellow circle right there. So I'm going to get rid of this circle here because it's now, I don't need it anymore. And I'm talking about this circle here, which was the goal. When I was asked a couple of weeks ago, where would the goal be to the downside if I really had a peak D in the S&P weekly chart, I circled that, and we're now into that area. And what are we doing? There's a real simple way of using technical tools in my methodology. You identify highs or lows, and if you can get parallel lines that coincide with the wicks, the outer wicks, most of the outer wicks on the upside or the downside, and then draw a parallel line with that, that creates a channel. I developed another technique, and that technique says that within the channel you could have what I call the inside track. Look how many times the S&P was repelled when it went into this little quarter-inch track over there. Did it just recently, hit that line, plop, pulls back. Now it is holding the support line. This is what I call, this is the sell or repellent zone. This is the buy or propellant zone. If in fact this S&P closes the week, it's a weekly chart, we should only be looking at it on a Friday. So this is intra-week, not even 2 days into the beginning of the week. So I'm going to have to say if this and if that. I'm going to say if, in fact, the low of 1926.03 is taken out on a closing basis this coming Friday, or any Friday, but especially if it's this Friday, that would suggest that this final dashed uptrend line, where it coincides with a sub-channel to the downside and a strong up channel, and that coincides right there, 1922, that would be the next target to the downside. How quickly? Doesn't really say. I'll be right back. Basil Chapman, this is the Tom O'Brien Show. My pleasure to be here, and I'll be right back. I'd love to take calls, 877-927-6648, and we'll continue with these charts, and we'll look at the Qs and the New York Stock Exchange and the VIX Index and bonds and the dollar and gold. I'll be back.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now. Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Thinkorswim, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing. Tom, take your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi everyone, Basil Chapman. I usually do the Tiger Technicians Hour, 11 to 12 every day. I'm sitting in for Tom O'Brien. My honor to be here, my pleasure. So let's go on with all these different things. I've got the Berkshire Hathaway chart. We'll come back to that. Let me just rather finish up the indexes. Look, the S&P, we discussed the S&P. So that makes the S&P right now, it gives the S&P 1950 would be very, 50 to 52 would be very strong resistance. And the way it's looking here, going into this candle on the left, says that if it was to go even to the 1938 level, you got to be careful because you could very quickly test the low of just a few days ago. And that impacts the weekly chart. But, of course, we have to wait for Friday. Look at this. This is the QQQ series. The QQQ series, which was just stupendous on the way up, has made a top in the weekly chart at 100.56. It's in a little sub-channel. It's in a decline. It's underneath the black line, which is the 9-period exponential moving average. The MACD, that's this green and red, those two moving averages right there, has turned negative with a very wide, now this is just 2 days into the week, a wide differential between the green, the faster moving average and the slow moving average, and the stochastic has gone down under 80%. And one of the reasons why we went short almost at the top of the S&P and the Dow is because it looked to me as if the QQQs would be the last to create their top. And as the QQQ was making that top in the daily, the others would start to lead to the downside, and I would have to wait for the weekly chart to close decisively for the first time under that 9-period exponential moving average, which it hasn't done. Look at this beautiful move, using this one moving average, a 9-period EMA, exponential moving average. It's the way it calculates the moving average itself. It puts the greatest weight on the last close. Now look at this. The moment it broke above that 9 EMA back on the week of the 2nd of May, you could have used this and said, I will stay long until it closes under that 9 EMA. And you would have had a move that took you from around the 85, 86 area to 96 if you didn't get out on a peak D over there at 100.56. I want to get these done because it's the monthly charts, the weekly and the monthlies, that are going to be so important. So let me go on and show you something else. In the monthly charts, I'll open this up. Look at the way this QQQ series, the Power Shares QQQ Trust series, has held that 9-period moving average, that black line. Look at the way the Dow, INDU, has held this black line. Look at the way the S&P, SPX.X, look at the way the S&P has held that black line. These are monthly charts. Look at the way the MACD's only now started turning down. There's the relative strength. There's the unbalanced volume flattening out. There's the slow stochastic still at 91%. So a lot has to happen to impact the monthly charts. I want to get to this one here, which is the New York Stock Exchange, NYA.X. Look at that. Under the 9 EMA, almost 2,000 stocks, very important index. New York Stock Exchange monthly chart has said, I'm done. I'm starting to make lower lows and maybe lower highs. And the daily chart has made that peak D top. It's pulling back in that arch formation under the 200-period exponential moving average. As I said to my subscribers, I am very concerned about this particular one because other than daily charts, which we've been using for shorting before and just gotten very quick gains and then pulled out, the weekly charts are now impacted. But I'm going to finish up with the weekly charts and say the monthly charts are the ones that will be seriously impacted if the weekly lows of just 3-4 days ago are taken out. That's going to be very negative action. Now I want to show you something else. For a very, very long time, I've made a big deal about the Vixa, the Volatility Index. I've made it just a kind of a prime technical tool of importance in my work. And I've done that for years. And that together with the Volatility Index plus in a bear phase, it means that anytime you get good news or bad news, all news is treated as bad news. And we've had nothing but good news lately, right? Now, isn't that interesting? But what I did talk about, and I've been doing this for about 3 to 4 weeks now, is I've been saying that for the first time, the monthly chart of the Volatility Index, let's move it to there, that's this one right here, is making a pattern that I call the H pattern that goes to a cup formation. And if the Volatility Index has just started today, it's just started leg B, or at least this week, leg B in the monthly chart. Other leg Bs have failed often. If this one holds, and in October, at any point in October, there's a push above 20.21, and you'll see why I'm talking about 21. The 21 level is where the Volatility Index has constantly been repelled. It just goes up there and then plop, it comes all the way back down. this is the first time there's been such a concerted mid-U formation. Now, how can I explain that? If you're listening and you're not looking, think of a U, a sharp U. This is an uppercase U. But within the U, you've got another little spike to the upside that continues the higher highs and higher lows, so that the whole thing makes like a W. Well, this particular little W here is very different. This is a very powerful move to the upside, and I cannot take it lightly. So I'm going to make it real simple. At 17.14 right now, the VIX is saying the selling pressure is intense, or intensifying. Not intense. Intense is up in the 21s or higher. If it drops at any point by Friday to the 14 to 15 area, but I'd say 1430 area is really the area. If it drops, I say, okay, maybe this is just one phase of a multiple series of attempts to move higher, and it will keep coming down, but it's not going to be a straight shot to the downside in the market. It's just going to be a series of volatile sessions to the downside, and then at some point you get another, like the 200-point move we had on Friday. You get a major surprise to the upside. So let's get on with our story, because what we want to look at, I want to show you this, and you tell me what you think. Have a look at this. I'm showing two panels. This panel on the right is showing gold, how it made that H pattern. Let me just quickly talk about that H pattern. The H pattern is chapter 17. Let me just go there, chapter 17, right there. It's a pattern that says that you keep coming down, and every time you try to rally, you fail and you take out the left side low bar, and it looks like a lowercase h. And it keeps doing that, and at some point you can make a very large lowercase m formation as that H just keeps playing out. Well, look at gold. Gold has done that. This is a monthly chart. There's the H that's going to an M. Look at silver, H that's going to an M. Look at copper, H that's going to an M. Look at platinum, H that's all. Let me just check. I think platinum is already 1.226, and the last major low was 1. This is already going to multi-year lows. So platinums, and that's telling us about the automobile industry, which is a shock to me. Everywhere I drive, I'm seeing Fords, and I like the styles of the new Fords. People seem to like them too. I've asked a number of people. I'll be right back. We'll talk about, and crude oil is on its way down, but this is it, the bond yield chart. We'll talk about that when I get back. 30-year made a new low. I'll be right back. Basil Chapman sitting in. I'm O'Brien.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
Tiger Real Estate Opportunity Fund is currently offering 4-year first mortgages on many of the fully renovated properties that it has purchased. The first mortgages are third-party appraised with a maximum loan-to-value ratio of 70%, providing a secured investment that pays a fixed return of 5% annually, which works out to a monthly income of more than $416 per $100,000 investment with your principal intact and secured. These 4-year first mortgages are perfect for anyone looking for a secured investment that provides monthly income much like a CD. For more information, email tigerfund@tfnn.com or click on the Tiger Real Estate Opportunity Fund banner along the right side of the tfnn.com homepage, or call our office directly at 877-518-9190. There's a limited supply, so act now.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. Untitled Chapter. So we're looking at the 30-year. This is what I send to my subscribers almost every week. It's a weekly chart, and it shows the 30-year T-bond yield, the TYX. That's in white. It shows in this golden color the 10-year T-note yield, TNX. And it shows in the cyan, light blue color, the 5-year T-note. What I did in my show this morning, and folks, if you're interested in these charts, and you're interested in the way I discuss and I elucidate the Chapman wave, just tune into my show Monday through Friday, 11 o'clock till noon, and I go through these different charts and I discuss them live as they unfolding. Sometimes I'll grab a chart like I did this morning live, and I say, "Hey, look at this! In this case, the volatility index has just gone to the 10 peak D in the 10-minute chart. We'll see if it pulls back. If it goes underneath 16.87." there could be a rally into the close. I would prefer, being a bear right now, I'd prefer a rally. I'd rather not close at the depths of the day, the low of the day, because then we'll use up that energy in the VIX by tomorrow morning. This way, you keep getting buyers in, and they keep having to cover. It's better that way. But you can use these charts. I wanted to show a chart, and what I discussed this morning, I even typed it in. Right there during my show, we were over here. Well, we were over here. And I said there could be a rally. I'm sorry, we were over here on that particular candle. Let me open it up right there. And what I'd said is we were talking about that particular 30-year T-bond yield. And I said this particular pattern can give you a pattern that I call, it's an uppercase A, capital A. It looks like the Eiffel Tower. It goes straight up and straight down. And if it takes out the left side low, it means one thing. If it doesn't, it's very positive. It says you could rally almost, or actually to the very top. Oh, yeah, we are. We were right there at that time. So the E-mini rallies, and what does it do? It goes there and fails, comes all the way back, takes out that left. Look, there's the H pattern, lowercase, that looks like a lowercase m, takes out the left side and goes right underneath it. The rule of thumb is if it takes out the left side, in this case 1.939, 19, I'm thinking in currencies, 1939.75, and doesn't that very next bar or that bar or the very next bar break above that level, it can go much deeper. And look, there it is, going much deeper. Not a good channel, because now you've got two trend lines. I drew that in just earlier before the show to show if you break under and then you can't break above it, that's now a resistance line. The reason why I'm doing that, a little exercise there, because that's what, look, there it is. There's that single leg A up. I call it a single leg A phenomenon. Very often happens early in the morning when there's a news report at 8:30. You get the yields, the E-mini spike up, or when you get the Fed report at 2 o'clock or 2:15 on a Wednesday, a spike in one direction, a spike in back again. Well, this is that spike up. And now the yield on a weekly basis has gone under 30.59 for leg D. And what I was saying, in terms of the bonds, and now let me go to the TLT. I'm sorry if I'm jumping around. Some of you are really picking this up nicely, I know. For some of you, you're just not used to my techniques, so maybe I'll do it a little slower. Let me show you the TLT, which is the Lehman 20-year T-bond fund. Look at that power move 1 day late in what I call a left side, right side price time match. One of the techniques that I teach in my CD, I was going to go to my CD and I'll do it now. Why not? This is the, are we looking at the cup formation? Yep, the cup formation. So that's slide 310. Let me just pop that in right there. Look, 310, hit it, and there we are. And look at this. You see that left side, beautiful left side, and to the right side, this is actually a multi-year gold chart going back from 1996 in the 540 area down to the low of the 280, whatever it was, and then back again. And look at the exact left side to the right side, price time match to the month. Pop, goes to leg F. Well, look at this. The TLT has gone to, well, it's one bar late. I'm sorry, it's 1 bar late. But right there, it's gone to the 119.43 target. And what is the price now? 119.41 was the high. It's at 119.36. Hasn't quite made the target, but it's within pennies in leg C. And since we always look for a leg D, when I had a caller yesterday who was wanting to know what to do with the TLT, I said, buy some now. And if it goes above today's candle, or even the candle of the 1st of October of 118.26 by 1 penny, add to your position. I hope he's done that, because it's a fantastic move. And now look what's happened. You've got a new leg C in the weekly chart. That's very positive. That means we're looking out a few weeks before you can get to D in bonds, and in the TLT, that is. And this is now leg, oh, we haven't done it yet. Sorry, I can't talk about it until we go to 119.44. If we hit 119.44, that starts leg C in the weekly and leg C in the monthly. Now let's go back to our charts. Isn't this fascinating? Look at this. The TLT, the 30-year yield has gone to a lower low. Now it's in leg D. But the 10-year is at 2.350, 23.5. It hasn't gone below the last low of 23.05. It should, by the way bonds are acting right now. Why? Money is flowing out of the equities. It's so fascinating into, dare I say it, excuse me, but into the safety of bonds. How about that? Look at the gold. The GLD is up 39 cents. If there was a currency of fear, gold should right now be up $25 to $35 and should gap up tomorrow. Could still do it. The day's young. But that's the way we're seeing something very, very different. So let's go back to the yield chart. The 5-year, which is really important. Well, they're all important in different ways. 30-year has its own function. 10-year, I believe, is closer to the mortgage rate. The 5-year has a different impetus and a different there's a different use for the 5-year. And in this particular case, if it breaks the support line, it's a 16.37. If it goes to 15.17, it's broken the trend line and should try to tackle the 14.95 last low of the week of the 15th of August. So what we're looking at, and not only that, look how close they're getting to get together here. They haven't been quite this close. Look, this is a parallel line. And we've been many times into this 3.0 area for the yields of the 30-year. You've also been many times into the yield of 2.3 for the 10-year, and the 5-year. You had a big gap. You didn't have very much in the yield because it was much, much lower in the whole period of 2012, late 2011 to 2012. But this goes back to the period of June of 2011. So this is going to be a really important phase. Now there's a chart that I picked up behind you, black background chart. Look what's happened. The wood is WOD. It's the iShares Global Timber and Forestry ETF. It has broken key support. It's made that H pattern that goes to an M. I'm looking at the charts now. You can see it, but it's a little squashed. I'll open it up. Look, you've broken. There's that H that goes to an M and has broken the left side low bar. That's not good. Here is the HGX, the Philadelphia Housing Sector Index. It's stuck in a trading range, which is good, but it's trading at 188. If it goes to 182 in the next week or two, not a good sign. So I don't want to be just the total bear over here, because there are a couple of stocks that are acting quite well. But that's not the issue. The issue is that I've been recommending that if you've had some very long-term gains, this is the appropriate time to take something off and enjoy yourself and say, hey, I've got core positions. I want to handle them a little differently. I believe in those stocks. I want to take a little bit off to reward myself, number one. Number two, it's good money management. We're getting to a really choppy market. What do you want to do? You want to take off some money, which you could put back into those stocks if they act well. How about we look at Procter & Gamble, the defensive, not Raytheon, but the defensive type stocks. Well, they are close to all-time highs. Procter & Gamble's trading at 83.30, but it's a peak E in the weekly chart, and I didn't update the daily. The daily is A, B, C, D, E, F. Whoa, a peak F and a pullback in that A formation. We've got to be careful because there's that currency play. Now, I didn't even discuss the currency play. If the dollar, did I do much on the dollar? No, I haven't. I'll go to the dollar now. In the next hour, I'll go through the actual stocks themselves, I think, a little bit in greater detail. But look at this. There's the E, and there's that F. When you make a peak F top, the 6th highest peak, and the technicals are failing, be careful. Be very careful. So if Procter & Gamble, which is trading at 83.33, in the next 3 to 5 trading sessions, closes under 82.30. 82.50 is about the area of safety. 82.30 closes under it. All of a sudden, it's underneath the 9-period moving average in the weekly chart. And 81.23 is the monthly. It's got a hold. I'll be right back. Basil Chapman sitting in for Tom O'Brien. My pleasure to be here. Dow's down 230. S&P's down 25.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Tom O'Brien.
Hi folks, Basil Chapman sitting here for Tom O'Brien. I'm showing you a chart here of Coca-Cola. I mean, if you had asked me, I just have to tell you, it is a shock to be looking at this when there's all this talk about health and whatever it is, and yet Coca-Cola is at all-time highs. Look at this chart, this monthly, and if I have two ways of counting it. I'm going to be very conservative right here. I'm calling it D/C, but there is no sign yet in the monthly chart. There's going to be a turn down, but I'm giving it the D first to carry over a previous buy signal in Coca-Cola. Look at the MACD's just turned up. Well, the month has just started, and the stochastics at 80%. But look at the weekly chart. This weekly chart looks. There's no other way I can count it. Unless I count this as 42.17 and 42.19, as I'm going to do that just because I like to be a little conservative. I'm calling it a Chapman Wave Phantom Peak A. This will be B. And it tells me that the letters you see are one behind in reality. This is the makeup that I've given. So Coke is at least in leg C. So that's the defensive play. You remember we're talking about how do the defensive stocks hold up in a situation like this, and leg C in the daily. So Coke is acting very well. So there are a couple of stocks that are defying the downturn, and that's really important to note them, note why they are the ones that are doing it, where they are in the sectors, and what pertains to their strength. And I'm not quite sure. So in the meantime, back at the ranch, let's do this because we're about to wrap up and come back again with the market closed. The Dow's down 240, S&P's down 26. So what we'll be looking at going into the close is, does the Dow, let me do the Dow here, INDU, does the Dow close almost at the lows, or almost at the lows? Is there a little bit of a rebound in the next 5 minutes? If it closes at the lows, there's a chance that overseas you will find that they will be copying us and there'll be some lousy action overseas, and then that could be reflected in the futures tomorrow morning. I prefer wanting the market to go lower. This is a very important, I remember hearing someone the other day saying, an analyst on CNBC saying, oh, we want a 10% correction because we want to be buying. We don't want this going up. We want to, and I said to myself, if there's a 10% correction, they're probably not going to be buying because it's going to look really ugly. And majority of people will not be putting the money, if they haven't been putting their money to work up until now, why would they put it when the market then drops? So I'm looking at this and I'm saying the weekly chart is absolutely imperative. What happens this Friday at the close is just going to tell me so much about October into November. And it's going to say that if we close weak, very much under the 16,900 level in the 9-period moving average of the Dow weekly chart, but especially if we close under the 16,750, where we are now, 16,750 area, that's going to say to me it will impact the monthly chart. And we've got to be prepared that the month of October actually makes a peak E-top, and then we've got to go from there. So I'm not saying just get out of everything. I'm saying put in your stops, be reasonable. You've had good profits in some stocks. Take something off. Reward yourself for that. At the same time, don't be careless. I personally, we have not been adding on the long side at all, except very quick positions, but mostly we're staying away from the long side. When the tide turns, I've got an expression that says, if you take the piece of driftwood and you throw it into the water at the ocean and the tide is going out, that driftwood will not come back on land until the tide changes. If the tide changes, comes up, you cannot get it to go out. It keeps coming back to shore. Get the tide right. Oh, I don't know if I can find it right now. I've got a beautiful chart. I'll show it in the next hour from my CD that shows the tide, trading the tide, really important. So we're almost out of time, and I'll be back in the next hour, and I believe I'll also have the great pleasure to speak with Andy Hecht before he does his show at 5 o'clock, and that should be fabulous because I want to get a rundown on some of the commodities, and I want to do some charting of those commodities. Dow's down 257, S&P's down 28. We're going to the low of the day. That makes that candle of the 2nd of October, then the Dow of 16,674, absolutely critical in the next day or two, and it makes the low in the S&P of 1927, was it? 1926.03. On October the 2nd, absolutely critical. And look what's happened. The S&P right now, it's a weekly chart, but right as of this moment, it's breaking that red line, that really important support level. We're going to be watching this real closely, and at least my subscribers and I, I don't like bear phases. Nobody's happy in a bear phase, and even if you're making money because you've got the right side of the trade, and we've been short the S&P via the 300% short position, it's not a happy time. It's just not a happy time. And it's nice to be making the money, but let me tell you, it's better when things are going up. I wonder if the malls are going to be so full that you can't find parking up here in the Northeast, especially the Boston area, if this continues. Because look at the RTH, which is the retail index, which has just been on a tear to the upside, making all-time highs in, what was last month, September, at 63.73, with a little doji candle, and a candle this month lower. I'm watching this real closely, going to that inside track resistance area, repellent area, right there at 63.72, peak D in the weekly chart, week of the 5th of September, pulling back, about to test the 9-period exponential moving average support. Weekly chart, got to wait until Friday to really discuss it cogently, but at least we're anticipating that this is a period of great volatility. What does volatility mean? It means going down. People hardly ever talk about the volatility going up. They always say, oh, that volatility, they only mention it when it's going down. So couple of things that I'm going to do just before we wrap up. I wanted to say that this VIX index is just a treasure. It has been something that has helped tremendously. Try to add it to your technical toolbox. Very important indicator. So as I'm looking at it right now, it's at 17.36. It's tackling the wick of last week's candle. We'll be seeing if this is going to hold into Friday, because it's a weekly chart. You've got to wait the full week. RTN, question in the den. RTN is Raytheon. Raytheon making a G/C in the monthly with that cup formation, and the weekly chart, well, the peak D and the daily. I'd be careful. Raytheon looks to me at 95.87 like it's going to test the 93 to 90 area over the next week or so. I'd be a little careful there. So now let me just double check two things here, because I'm not used to the 4 o'clock wrap up. I'm going to put that down arrow there for the RTH. Oh, and the other thing that we will look at as we're about to go, I didn't talk about high-grade copper. High-grade copper is holding quite nicely, but it has pulled back. It's at 3.03. And the pattern that I'm looking at says it should fail fairly soon. So I'll be back straight after this. Basil Chapman sitting in for Tom O'Brien. Dow's down 269. S&P's down almost 30. Ugly day. And here's that candle that we're looking at right there. That's the candle. I'll be back straight after this. Hold tight. See you after the break. Hi, everyone. This is Basil Chapman sitting in for Tom O'Brien, the one and only Tom O'Brien. What? I was just listening to that commercial. I have to agree with it. Tom has put together a fantastic team here at TFNN, and we're all about education. We're all about trying our absolute best to impart to you our particular knowledge, gained in some cases, garnered over multi years. And in this particular instance, what we'd be looking at is I'm going to be interviewing Andy Hecht. Andy's going to be talking about commodities. You've got John Logan early in the morning, starts off the show, and he goes internationally. He just looks at all the different, mediums, different indexes, the currencies, the commodities, whatever it is. And then you've got Steve Rose, and I come on 11 o'clock till 12 with my Tiger Technicians Hour. My daily service is called the opening call. And in fact, we have been mostly short for a couple of weeks now based on my methodology. Now, let me just unfreeze my camera here, if you don't mind. 1 second. I'm going to do this one more time. Do that. And we are on, I believe. We are rocking and rolling or not? Oh, that was the wrong thing. That was the wrong camera. Let me do this one more time. I'll try to do it. So yeah, we are. We're back, and so while I'm looking at this, I'm showing you the chart. There are 4 time frames which I usually show my subscribers, and there's a daily on the left, the weekly on the right, the monthly on right on the in the middle is the weekly, on the right is the monthly. Right over here is a 120-minute chart, and there's one picture gives you everything from the near term, the very near intraday term, to looking out. Look at the monthly chart. Look at this. That black line represents the 9-period exponential moving average, and we have not gone closed underneath that. In the Dow's case, it's 16,630. Yep, 16,638. Haven't closed underneath that 9-period moving average since it broke above back on the week of, back in June of 2012. So we're due for some kind of a consolidation. That's what we're getting here. So let me do a couple of things. Let me just run the numbers. The Dow closed down 272 at 16,719. The daily looks like it wants to test 16,674. If it breaks that, the next area of support is going to be really important. 16,066 is important, but really the 16,570s, 530s is going to be very important. The monthly chart is right there. I spoke about it, but look at this weekly chart. It's about to test that uptrend line. So this is a key moment. Look, the MACD and stochastic are very negative. The S&P, I'll do this right now, SPX.X. The S&P right now, same thing. It's a weekly chart, but right at this moment, it's broken the key support right there. That monthly chart says that if it takes out 19.19 by the end of the month. If it closes under that, that's going to be the first negative sign in the monthly chart. The composite index closed down 69 at 4,385. Gold is up $3. It should be up $30. It should be up $40. It just hasn't become a currency of fear. Bonds have become the currency of fear. In fact, bonds are up $1.10 at 140 and 22.30 seconds. Look at this chart of bonds. Look at the TLT. The TLT started leg C. Did it go to that level? 119.43. It needs 2 cents. No, it's exactly. It has paralleled the high of the 29th of August. It needs 1 penny above that to start an official leg C. And if it does that, it becomes leg C in the weekly chart, and it becomes leg C in the monthly. Oh, I haven't explained that. In the Chapman methodology, you identify the lowest, most obvious low bar, and then you merely count each successively higher peak. At peak D, the 4th highest peak, that's where you can expect some things to change. Sometimes it doesn't. Sometimes it just continues higher. That's part of the different techniques that I teach when I do my Master Trader series based on the Chapman wave. So bonds have become a migration from equities into the so-called safety of bonds. Isn't that ironic? Now let's go on, and we're going to look at the dollar, because the dollar is absolutely important here. Currencies don't change on a dime. In fact, currencies continue higher in their major trends for quite some time. But look, the dollar's made that peak D. We spoke about that peak D. The MACD's turning down, still very good. Stochastic's at 81%. It's starting to weaken. So I suspect that the dollar should pull back here. Why isn't gold moving up over the night, over tonight, into tomorrow? We're going to be watching gold very closely, and we'll talk a little bit about that when we meet with Andy Hecht in a few minutes. Now, the dollar is, weekly chart is making a peak C. That should still go to a D, and the monthly chart finally hit that 200-period exponential moving average, which it hasn't been even close to for a couple of years. And now look at this. It's touching that line at 86.42, right there, that golden line. That is the dollar's nemesis. It's going to have a tough time trying to get through without a little bit of a breather here. So I think we've covered a bunch of things. I want to go to our first caller. We've got Lou in Nashua. Lou, how are you? And I'm just checking in to see if Lou is there. And oops, I'm sorry, he's gone. All right, sorry about that. Lou wanted to look at the E-minis. Lou, if you haven't got the E-minis yet, yeah, maybe there's a play overnight when the futures and the overseas indexes follow us and probably open sharply lower. But when you close at the low, very often you can get a bounce. Look at this. You can see it right there. We did that on the, look, closed at the low on the 25th of September at 16,945. The next day, the low was 16,948. We had that big spike up, and the same thing happened. Well, we'll see if it's going to happen here. More than likely, there will be selling pressure. Is it alleviated before the market opens tomorrow? Is the question. So, that was important. Now, I'm going to do this because I wanted to show you something that I consider to be one of the major factors in market moves, and it's called the Volatility Index. There was a period just recently where I heard people saying the VIX is dead. This is the Volatility Index. I get it by going $VIX.X. I would advise you, when I've given talks lately, I've advised folks in the audience, please check out from your service, your trading service, whatever platform you use, just ask them what it is that you have to go to get the VIX index, because you can get it VIX for some people. For me, it's $VIX.X on TradeStation. There are different ways. But the most important thing is, where does the weekly and monthly close? The weekly so far is breaking out above the 200-period exponential moving average. Right there. This is the weekly chart. Here's the daily. Peak D trying to retest 1789. But look at this. This is the weekly chart. If it continues rallying, and for any reason, I don't care whether we pull back tomorrow and Thursday, but suddenly Friday there's a big spike, and the VIX index closes above this 200-period exponential moving average, I would have to say there's a chance that the 21s, the most recent historical period that we've got, is going from July. Is that July? I should have put the date right there. From June of 2013 at 21.91 at peak D, pulls back sharply, goes up to 21.34 in October of 2013, pulls back again to the 11s, holds that green line, goes to 21.48. Another, this is a peak B minus at 21.48. The week of the 7th of February of this year, pulls back to a lower low, goes to 10.28 just the other day. We are up 70% in the VIX index. The market's not down 70%. See, it doesn't quite work that way. So this is a very, very important moment, that if that volatility index keeps rallying with the MACD going up, look at the histogram, look at that 0% line. It's at 0.44. It's rallying, and that's going to be very important. And the stochastic is okay. It's not great. So the stochastic at 53%, believe me, if you're a bull, you don't want to see the stochastic of the VIX weekly chart be great, because that would be over 80%. And that VIX will be up in the 19s or 20s. So as long as the VIX is running into the upper teens, low 20s, this market has a terrible problem holding rallies. The moment the VIX starts to pull back, goes towards the 1520 to 1420 area, you'll get really strong counter-trend rallies. And remember, what we're seeing now, and I made a big thing for my subscribers of my opening call, and that is to say that we need two things: a higher VIX, and for the market to ignore good news and go down. Oh, we are at a break. So we'll be back, and we've got, what do you want to look at? Okay, I'll be right back with Lou, and we'll be back with Andy Hecht. Basil Chapman sitting in for Tom O'Brien. Be right back.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how EverBank can help keep your money thriving just the way you want. Is growing your money a priority? EverBank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? EverBank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. EverBank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. EverBank is a member FDIC and equal housing lender.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pezzamento, Andy Hecht, Thinkorswim, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks. Basil Chapman sitting in for Tom O'Brien. The Dow was down 272 at 16,719. S&P down 30 at 1935. And we are going to go to Lou in Nashua, New Hampshire. Hi, Lou. How are you?
Fine. How are you?
I'm well, thank you. You'd like to look at?
The E-mini.
Okay. Yeah, Lou, do you have a position at all?
Yes, I have a put.
Okay.
At, 1970.
So you have a single put at 19 what?
70.
Whoa. So, if you had two, it would be a real easy decision. I would just say to you, well, it's too late to do it now. I would say to you, first thing in the morning, I would take one position off. I'd keep the other. If this is for a October or November?
October.
It's for October. I think you're going to have another chance to do it. My VIX reading and my reading of the S&P and the Dow says that we're getting real close to some kind of a bounce, just an oversold bounce, and that's going to give you another chance. So this is my recommendation. Because you've got a single put, you really don't, you've had a fantastic gain. I would not push my luck with this. At the open tomorrow, especially if we are down sharply, I would just get out of that put. Now, even if the market drops another 500 points afterwards, I would say a bird in the hand is worth two in the bush. And not only that, in options, to be able to get this kind of price, I don't have to tell you, Lou, this is not, it doesn't happen. It happens a few times a year that this kind of gain is made so quickly, right?
Right.
So I'm going to recommend that you do take profits. I would love to be able to say to you, I can see the S&P going much lower in October, but you're playing a different game completely. You're playing the short-term trend. So I'm going to think about it. You don't have to do it. Now, your problem is, what if tomorrow there's a sudden gap to the upside? It can happen because we close almost at the low. If that's the case, then I would still say to you, I'm going to recommend that you take profits and you wait for a bounce and you just keep doing what you've been doing. You play the bounces on the short side. But we are within 2 days of at least a spring to the upside like we had on Friday, because unless we smash to the downside and we hold at the close tomorrow, another triple-digit down day, if that happens, that means 1918 is a possibility on the E-minis, and that would be fantastic. So your wish is that we actually gap down huge in the morning and you'll get the very best price almost within 3 minutes of the open. I would take my profits off on that put. I was just going to say, congratulations, a fabulous, fabulous trade.
Thank you.
Good. So that's Lou in Nashua, and you did the trade, Lou. Fantastic. Let's go to Andy Hecht. Andy, how are you?
Hey, Basil. Thank you so much for having me on. How are you? I listen to you in the morning while I'm looking at the markets, and I appreciate your show, and it's a pleasure to be on with you.
Well, thank you. Likewise, we've got a little patting on the back relations going on here. So, Andy, I have a couple
I wanted to tell you one thing. One of the beautiful things about TFNN is that we all come at these markets from different perspectives. And I am much more medium to longer term, and I'm much more fundamentally driven than chart driven.
Right.
So, my comments now, that I'll give you on some of the commodities that I'm seeing here are kind of macro comments. And I actually, just for everyone out there, I put up 6 articles yesterday on Seeking Alpha, which were quarterly, the end of the third quarter review, and what to look forward to in the fourth quarter for every commodity sector: energy, precious metals, base metals, grains, animal protein, and soft commodities.
Fabulous.
So I have some pretty strong convictions here. You want to start with gold?
Yeah, let's go to the gold. I'm going to ask you now. I've got the continuous I've got the continuous contract up. And at this particular point, the reason I have it is because it shows the very long term, since you like to look at the long term. And I've got that H pattern that goes to a lowercase m. So even though there could be a bounce, I'm negative on gold. So you tell me what you're thinking. Oops.
Am I with you, Basil? Hello? Hello? I'll try to call again.
So, Andy there. So I'll just I'll keep talking about this because I'm not sure if we had a little technical glitch there. What we're looking at here is gold. In my charts here, gold is just a little bit of a blip to the upside. This blip to the upside corresponds to the technicals moving higher at the same time as when we're looking at the technicals, the MACD is moving higher and the slow stochastic is moving higher, and you've been seeing lower prices. So that's a positive divergence. So if we look at the dollar index, and I just need to have am I on the question mark? Because I'm not hearing anything. So when I'm looking at this particular chart here of gold, and I put the relationship with the DXY, the dollar, you will see the dollar has made a peak D. Remember, the premise of the Chapman wave is to go from the lowest low bar and then move to the upside where you get a peak D. It was Andy. So Andy is back. I wasn't sure.
I'm back with you. Sorry about that. We're having a little technical difficulty. What I'm seeing in gold, Basil, is the following. First of all, I think this dollar rally is for real, and I think it's interest rate differential based. The interest rates in Europe, as you know, are very low. The dollar is the ultimate currency of the world still. Everything is priced in dollars. Every commodity is priced in dollars. And dollars are attracting other investment especially now that the stock market's going down, because there's nowhere else to go. Now, what's happening in gold is you have very little interest here. Open interest in gold is flatlining. It's really not an environment that's friendly to gold, with the dollar rallying and with the prospect of higher interest rates in the future. Therefore, the long-term resistance at 1180, I believe, will break. And I believe we're on our way to about 1045 in gold. All of my fundamental models are telling me that. I just, silver cracked through the support, 18.5. Platinum cracked through its support at 1,300. I believe it's only so right now we're in a situation, Basil, where either silver and platinum are too cheap or gold is too expensive. When I look at the whole picture, when I look at the dollar, when I look at what's going on in other commodity prices, I have to say to myself, gold is too expensive here. It's just a matter of time, but it is going to crack to the downside.
So, Andy, you've given us so much information. I don't want to run out of time before the break comes. And can you just tell us, you've got a service. Your service is called, and tell us what you do.
The Technimental Commodity Report.
Right.
And I will also, I'll be on after you're done today, and I'll be going through each one of these markets, the fundamentals, the technicals. One interesting thing, even though I'm bearish on the commodities sector in general, Basil, there are diamonds out there. Coffee, there's fundamental reasons that thing made a new high on the year today, a new 3-year high. I think we're going after new highs.
Well.
Cocoa, another market that's very bullish here.
Cotton is acting well? Cotton
I don't like. Too much around, too much inventories.
Okay. So, folks, please stay tuned for Andy's show at 5 o'clock. Andy does fantastic, very original work here at TFNN. It is a pleasure to hear him. Thank you so much, Andy. I appreciate you.
Thanks, Basil. Talk to you soon.
Thank you.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
You take a hands-on approach to managing your investments. And whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC. Tiger Real Estate Opportunity Fund is currently offering 4-year first mortgages on many of the fully renovated properties that it has purchased. The first mortgages are third-party appraised with a maximum loan-to-value ratio of 70%, providing a secured investment that pays a fixed return of 5% annually, which works out to a monthly income of more than $416 per $100,000 investment with your principal intact and secured. These 4-year first mortgages are perfect for anyone looking for a secured investment that provides monthly income much like a CD. For more information, email tigerfund@tfnn.com or click on the Tiger Real Estate Opportunity Fund banner along the right side of the tfnn.com homepage, or call our office directly at 877-518-9190. There's a limited supply, so act now.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. Basil Chapman sitting in for Tom O'Brien, and let me just quickly tell you, my service is the opening call, daily service here at TFNN. I start sending out my charts way early, about 6:30 in the morning, 7 o'clock, sending out a whole bunch. This is already tomorrow's that I've prepared. This is for the Dow. I always show the Dow, and I explain what we're looking at based on the Chapman Wave methodology. And you can see that I've already, for a while now, we've been looking at this arch formation. I've drawn in this what I call the Chapman Wave inside wedge support level, which says that the next level of support tomorrow will be 16,597, which has to hold, and that the resistance will be somewhere into about the 16,800, 820 area if there's a very strong rebound, but we're going to be watching that real closely. And I talk about how the MACD and the stochastic, slow stochastic, what their function is, and how the relationship of this wide beta between the differential, 9-period differential, the green line of the MACD, the moving average convergence divergence. These things have complicated names, but it's just called the MACD, M-A-C-D. And as long as that remains wide, and as long as that 0% line, those red lines to the downside are strong, that's saying that there is downward pressure. And I've gone from a sell signal to a sell mode in the daily. But I would like to say that my weekly chart of the Dow has gone to a sell signal and upgraded to a sell mode. I can't do that because the week has only just begun. 2 days, that's not a week. You need the full. You need Friday at 4 o'clock. If Friday at 4 o'clock we are closing underneath 16,650, we give it a little room, 16,630 to 16,600. If we've taken out that area, that just says that is a top of consequence. And it is a weekly top, not a daily, but a weekly. And I've gone from a sell signal to a sell mode almost in 1 week. And if that's the case, the stochastic and the MACD, which are negative right now, are going to suggest that we will take out the 16,333 level, And that was the big thing that we've been talking about for weeks based on the Dow. Will this be the type of move that takes out the low of 16,333 that was made back at the beginning of August? Because if it does, that is going to impact negatively the monthly chart, because look at this monthly chart. Now, I know that the Dow, it's just 30 stocks, etc. Hey, I've done this every single day just about for the past over 30 years. I've given a market call on the Dow. This is my belief that the Dow is really important. It is part of the generals. And if the generals can't lead without the soldiers. And if you look at the monthly chart, it's getting real close to testing that 9-period exponential moving average, as well as this up channel inside track series right here. But even more important, when I talk about the soldiers, what about the IWM? That has failed with a peak F top in the Chapman wave with a terrible stochastic in MACD. You cannot have a market going higher and higher without the IWM participating, number one, the Russell 2000 stocks. And look at this. It has got the same pattern, and it says that if it continues at this pace, that by the end of October, maybe the first week of November, or it could be before then, I don't know, we will test 100. Which 100.13 was the low made the week of the 30th of August, 2013. The only way that can change is if there's just a sudden exhaustion move to the downside that turns the VIX lower back into the 14s or 13s, and the IWM has a rally that takes it over 112. You can see 111.93. That's the 9-period exponential moving average. I'd already drawn that little H pattern. You know, talk about that H pattern. Let me just show you something about patterns. I drew this a year ago. I drew that pattern right there and that pattern right there. I included this third arch formation just recently, but that was done a year ago. Why? Because it's the pattern that I always talk about in my CD, Introducing the Chapman Wave Methodology. That H pattern that forms, it's going to be very familiar to you. That's why I'd like to show it to you now. If we're going to continue down in the month of October, this is the pattern. It comes down, it makes the lowercase h, it takes out that left side low bar, goes down further, it does it again, boom, and then it does it again. And then at some point, it tries to make the M, the lowercase h that goes to an M pattern. So this is what we were looking at. It's what I had already predicted a year ago. That's why I said that 200-period moving average is going to be tremendous resistance. It failed right there back in August of 2013, came down, retested the 114.68 low. It went a little bit lower. That was at 46. It went a little lower the third week, on the 3rd, yes, the 3rd of January of 2014. Went almost up to that line, failed, came down, held this dashed line, the inside Chapman Wave, inside wedge. And now we're looking at a situation, yeah, you might get a little bit of a bounce, but the way I'm looking at it, we should take out 114 support at some point, probably in October. I'm not sure yet. But it depends on how we bounce and if we bounce, because if the dollar suddenly regains strength after just 3 to 7 sessions of consolidating, that's going to be quite amazing. So now let me do a couple of things. Oh, we've got Mike in Toronto. Mike, how are you?
Yeah, hi, Basil. Thanks for taking my call.
Oh, it's my pleasure.
Yeah, I wanted to study the VXX.
Yes.
On the weekly.
Okay.
Okay. Now, the reason why is when you go back to the beginning of the year, the key support level hovering around, I would say mostly of January into early February, it seemed to hover around 40.
Okay.
And I drew a horizontal support line into about beginning of May, and that was the key support level, 40, and then it suddenly broke down as the market broke out to new highs. Now, obviously, the VXX is trending higher now, and it is sloping up higher. Realistically, the previous support becomes a new resistance rule, kicks in, so the first ultimate target would be around the 40 zone before it consolidates.
So, would you mind? I'm looking at the VXX, which is the iPath S&P 500 VIX short term. Would you mind if I go to the VIX itself?
You can. It's your show. It's just that if you have a chart on the VXX and you look on the weekly, if you draw a horizontal trend line beginning from the beginning of the year, it seems to be stuck around 40. Okay, and it bounced off it when we had the decline in February.
Correct.
And when it came down, I guess the market went back down to 40, held, bounced again, and finally broke down at the beginning of May. And the obvious observation is that the previous support becomes the new resistance, and I'm looking at a target in that zone, initial ultimate target up there. I mean, eventually we'll go much higher, but...
So let me do something else. I've got a technique that I call Chapman wave. It's the A to B equals C to D, but it's a little different because it gives you time and price. In this case, it didn't give you the time, it gave you the price. And if you go to the high bar of the week of the 11th of October of the VXX at 69.64, and you come down to the low that was made, the line that you're talking about, a 40 round number low, well, it went to 39.85 the first couple of weeks of January. Then it bounces up. That's A to B. And now you get your C, which starts the week of the 7th of February at 55.22. And that goes down to... It should have been round about 26. Let's call it 26. Well, the actual low was 26.95, and that was 26.95, 26.81. 26.81 was the low on the week of the 19th of September. So in a sense, you've got your A to B equals C to D. That's number one. Number two is, if you don't mind, I'm going to the reason why I wanted to go to my VIX.X, my actual VIX contract, is that I've got other things that I can explain to you which corresponds kind of to what you're talking about. So if you want to go to the equivalent of the highs, 21.48 would have been the high the week of February the 7th of this year. And then the low was 11.69 just before that. That was in December. Now what we're looking at is that there's a cup formation. You were making lower lows and lower highs. All of a sudden, you're making higher highs and higher lows. To me, this chart that I've got now, at least because I've already got it notated, explains in a sense what you're trying to portray. It gives it gives you the visual ramifications. And now there's something else that I'm going to include. There's something called the XIV. Most people don't even know about it, let alone look at it. We've already shorted it once before and done very well. We didn't short it this time. It's the inversion. It's the VS inverse VIX short term, and it's giving that same pattern. It's the H pattern in the weekly chart. Now let me show this upside down, VIX.X. It is the cup formation right there. So we've got exactly what you're talking about. We've got verification that you've got the power move, at least at this point, moving to the upside of the VXX. You want to hold on and we'll finish it up?
Okay.
Okay, we've got Mike in Toronto holding on. We're looking at the VXX. The Dow is down 272, S&P down 30. I'll be right back. Basil Chapman sitting for Tom O'Brien.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. Join Andy Hecht as he shows you how to make money in commodities. The Commodities Hour, next on TFNN.
Tom O'Brien.
Hi, folks. Basil Chapman sitting in for Tom O'Brien, and we are on with Mike in Toronto. We're looking at the VXX, and I've got the VIX index monthly chart up, and it shows in the Chapman wave from the low bar back in at 9.39 back in December of 2006. It went peak A, B, C, 4 peaks higher to D. October of 2008 at 89.53, the bank crisis, and the most recent low has been 10.28. Now, this is the one that's based on the S&P futures or New York Stock Exchange futures. No, S&P futures. And what we're looking at here is CBOE Volatility Index, and it's many times gone to a leg A and then a B. But what's very interesting in this particular chart, because there's a left side to a right side price time match that says that if there is an acceleration in the VIX index in October that takes it over 22 to 23, that'll be on a weekly basis as a monthly chart, so you're talking about the whole of October. That's going to set up something that says be very careful, because for the first time the price has the potential, with the MACD rallying like this, the relative strength rallying, and the slow stochastic only at 37%, but will quickly start to climb if, in fact, the price moves over that 20 to 21 area. This is going to be the real test of whether there's going to be a cup formation in the monthly chart of the VIX. Everything will fail if out of the blue the VIX suddenly closes one of the weeks down under 15, probably down closer to 14, and that says not going to make it. We're just we've had a great rally, but now we need a timeout, and the market will rally as the VIX comes down. So, Mike, I just wanted to explain to you that the relationship is the daily that goes to the weekly, and the weekly then goes to the monthly. Do you have a position in the VXX? No, that was Mike just lost Mike. Okay, sorry.
No, I'm there. I hear you.
So do you have a position in the VXX?
Yes, I do. Okay.
So as I see it right now, it's going to be speed. It has to be speed to the upside and rather than speed to the downside. And I can just tell you this, that if your VXX starts to, if you have enough of a position, if the VXX takes out last week's high of 32.95, I would take one small part of my position and I'd raise the stop as much as I could, so that at least I know I've garnered, one of the few times it's been such a spectacular move to the upside in the VIX, I've garnered profits from that. So I hope that helps you.
Yeah, but we're at a stage now on the daily where the exponential moving averages have converged, and basically you've got the golden cross about to kick in here. You got some bullish crosses on the 20 and the 50, and then the 50 and the 200 are beginning to converge, right? So wouldn't the algorithms kick in and make this thing go even higher?
Yeah, I think you're right. But at the same time, I will talk on my show tomorrow at 11 o'clock a.m. I'll take a moment. I'm going to talk about the various crossovers and how very often they cross right at a point where they're about to have an inflection, pull back, and then later on they can continue. So I'm always a little nervous because it takes so long for the slower moving averages to finally cross. When they do, it's almost at a time where on the shorter term trend, they could have a pullback. But at this particular point, I've got leg A, B in the VXX, and if it breaks above 32.95, that's going to only be C in the VXX. But I use the root. The root is my VIX index, and this is derivative. And my VIX index has made a peak D, and if it goes over 1789, I'm suspecting that at some point between tomorrow and Thursday that we do get some kind of inflection, and somehow the VIX will just suddenly pull back, and the market will have a bit of a breather rally. But believe me, tomorrow's opening is going to be so important. Hey, thanks so much for calling.
Thank you very much.
I appreciate that. So, folks, let's do this because, as I say, my opening call, my daily service, we've been shorting for a couple of weeks now based on the Chapman Wave methodology. We're going to be adding to those shorts, but right at this particular point, it's a little tough to add except to the stocks that have just recently made highs. For instance, let me show you this. We are short Marriott. Now, who would go short Marriott when it's been one of the best stocks on the market? It's just been fantastic. It went to a high of 73.28 just 3 weeks ago, and that was a peak in the Chapman Wave. So we shorted almost right at the top as it was making that F, and we were shorting from 72.19, the all-time high is 73.28. It's about just over a point off the all-time high, and now it's down at 66. And I'm saying to myself, if this is a reflection of international travel, international the economy, etc., I've got to monitor this really closely. 62.44 is the 9-period moving average support in the weekly chart. There's a lot going on here on this chart because of the speed with which it's gone. And then there's a technique I use, which is the Chapman wave Roman candle of last week. It's already halfway, more than halfway into the wick. That says there's a good chance it's going to test the low of 65.48, and that's going to be the big test. And the MACD's turning down, and the stochastic's turning down. These are very important stocks. Look at Berkshire Hathaway, BRK.B. Berkshire Hathaway looks like it's making some kind of a top. It's been an amazing stock. All-time high, same little candle formation with that evening star, I believe it is, leg F in the monthly chart. I'm watching these really closely. So all I can say is I have got a sense here that the last couple of weeks I've seen so much of the fake moves to the upside, and then the market pulls back. This is going to be a major, major period of testing whether or not how can I put it? Testing not just the daily charts, but now we're including the weekly charts and possibly monthly charts. That's why I consider the volatility index, the news, and stocks that have done really well, like a Google. Look at a Google. It's pulling back sharply in the monthly chart after it's making that arch formation in the monthly chart. It's been an amazing stock. Look at Netflix. Look at that. Netflix, same thing. It's up. It's having a high-level consolidation, but I'm watching it real closely. And look at Apple. Apple has been the absolute darling, but it's got a peak F in the weekly. It's got a possible peak D in the monthly. And I can just tell you this, that if Apple takes out, it's at 98.75 with this particular pattern, it's just about to take that up channel support level out. If Apple closes on Friday underneath 97, it's at 98.83. The next level of support is 96.14, and below that there's very little until it gets to 93.28. So Apple has to have a fabulous week and close somewhere in the 101 area to say, I'm not part of this, folks. I'm in my own orbit. But I'm not sure it can do that. So I just wanted to go through a couple of things like that. On my show tomorrow, I'm going to be going through a number of the indexes. I'm going to show you, look at the XLV, an amazing mover. I'll talk about that tomorrow. Just turned down. And the monthly chart leg D, hey, this is a period to be very cautious. That's all I'm going to say. Thanks so much for being here. Thank you, Tom, for allowing me to sit in this seat. And I will be back tomorrow for my usual show. And have a great day. Stay tuned for Andy Hecht.